You opened your phone last week and saw it somewhere. 118,727 foreclosure filings in Q1 2026. The Wall Street Journal ran it, Fox Business ran it. Every headline used the same word, rising. And if you're a homeowner, a landlord, or someone with savings in the market, the message felt clear. Be worried. But here's what I want to show you. Adam, the company that actually published the foreclosure data, titled their own report, Foreclosure Activity Rises as Market Continues to Normalize. Not crisis, not collapse, but normalize. Hi, I'm Mario from Ritsel Notes, and in this video I'm going to show you why that single word changes everything, and why the people reading those headlines correctly aren't the ones you'd expect. Let's start with the comparison that's been making rounds everywhere. People keep saying 2026 looks exactly like 2008. Here's exactly how you'd know it doesn't. 2008 was a loan quality crisis. Banks were writing mortgages for borrowers who couldn't afford the basic monthly payment. Liar loans, no doc loans, adjustable rate products built to explode the moment that rates move. When rates adjusted and home values dropped, millions of people couldn't cover the fundamental loan payment itself. There was no equity cushion. The collateral had evaporated. What's driving the stress in 2026 is completely different. Most of the borrowers showing up on these foreclosure numbers holds mortgage rates at 3%, 3.5%, or maybe 4%. Interest rates that most new buyers today would consider a dream. The loan payment is affordable. What's breaking the budget is everything that gets added on top of it. According to data from Insurify, homeowners' insurance premiums rose by an average of $2,948 in 2025, a 12% jump on a single year. Adam reports that average annual property tax burdens climbed to $4,427, and HOA dues are trending upwards in communities across the country. So a borrower who locked in a great rate 4 years ago is now getting hit on 3 fronts they didn't budget for when they originally signed the papers. Here's why this distinction matters so much. A borrower who can't afford the mortgage payment itself has a fundamental impairment, a hard problem to fix. A borrower who can afford the mortgage but can't cover the insurance and the tax and the HOA that's all on top of it, that has a curable cost problem. And that changes everything about how a note investor approaches the data. Let me give you that reframe and then walk through exactly how it works in practice. When you buy a mortgage note, you are not buying a house. You're buying the debt that's secured by that house. You stepped into the lender's position, the same position the bank occupied when the loan was originally made. The borrower owes you the monthly payment. The property backs the promise. The terms are written into a legal contract that the borrower already signed in the past. So when you see a foreclosure headline as a note investor, what you're actually reading is the inventory data. More foreclosure filings means more notes entering the secondary market. That's the market where Lorraine and I operate, where performing and non-performing loans get packaged and sold off by the original lenders. And when supplies goes up, prices goes down. Bigger discounts to the unpaid loan balances, better entry points, more distance between what you pay and what the property is actually worth. Let me show you a real deal structure, the kind of note that might be evaluating in this environment. A note is secured by a house worth $95,000 in Ohio. The borrower owes $62,000. They've fallen 90 days behind. Not because the mortgage is unaffordable, but because the insurance jumped $300 a month and the escrow payment ballooned. The original bank doesn't want to work out a modification for one loan. They sell it into the secondary market at, let's assume, a discount of 85 cents on the dollar. That's 52,700 on a 62,000 loan balance on a 95,000 house. You buy that note, your loan to value is 52,700 on a 95,000 property. That's your investment. About 55%. The property would need to lose nearly half its value before your position was technically underwater. That gap between what you paid and what the property is worth, that's your collateral cushion. Now, what do you do with a borrower who's behind because of the insurance costs? Not because the underlying loan is broken. You simply reach out through a licensed servicer who handles all of this on your behalf, and you work towards a resolution. The options, in order of preference, my preference, is a loan modification that restructures the escrow to terms the borrower can actually meet. A repayment plan that brings the account current over time. Or a short payoff arrangement if the borrower wants to sell or just exit the property. Foreclosure is absolutely the last resort, and usually the least profitable outcome. You are not hoping to take the house. You're hoping to get paid monthly. One more thing worth understanding here. The FHA now limits certain loan modifications to once on every 24 months. For a large bank servicer managing thousands of loans with a standardized process, that's a constraint. For a private note investor like you or me working directly with the borrower, it's an opening. You can offer the flexible solution that the big servicer just can't. And done well, that aligns your return with the borrower's financial stability. Now, I want to get into non-performing notes in specific, because this is where the Q1 2026 data becomes most interesting. A non-performing note is a loan where the borrower has stopped making payments. You buy it at a steep discount, not just to the property value, but to the unpaid loan balance itself. The discount is there because the uncertainty about how repayment will happen. You're pricing that uncertainty into a lower purchase price. In a normalizing foreclosure environment, which is exactly what Adam is describing in Q1 2026, more non-performing notes flows into the secondary market. More supply means more options, more competitive pricing, and more room to be selective. The same news cycles that creates anxiety for most real estate investors creates a buying environment for note investors who are prepared. And if you're thinking about positioning notes inside a self-directed IRA or a solo 401k, the same math applies. More notes, better pricing, and those returns compound inside a tax advantage structure. Let me go back to the data for a moment, because the numbers deserve a second look. 118,727 Q1 2026 filings. That works out to one filing for every 1,211 housing units. Not 1 in 10, not 1 in 100, but 1 for every 1,211. The 6-year comparison window that makes this look alarming includes 2020, 21, and 22. Years when federal moratoriums pushed filings to historic lows. We weren't in a healthy market during those years. We were in a government-protected one. What's happening in 2026 is a return to how the market has always functioned. The average foreclosure timeline, 577 days, down 14% from the prior year. That tells you that the process is moving faster than it did. That's the 6th straight quarter decline. A system that processes faster means faster resolutions when you need it. I want to be honest about what the data does flag. Adam's CEO noted continued rises in foreclosure starts and bank repossessions, which suggests some financial pressure is building for some borrowers. And that's real. That correct response is not fear, it's diligence. Let me walk you through what diligence looks like in this specific environment, because the foreclosure data, read correctly, actually improves your checklist. The first thing you look at is loan to value. The loan to the value ratio is the most important number in any deal. If a note has a $75,000 still owed and the property is worth $95,000, that's a 79% loan to value. Reasonable, but not generous when carrying costs are pushing people into default. If you're paying $55,000 for that $75,000 balance on a $95,000 property, your effective investment to value drops to about 58%. Now you have a real cushion. The second thing is payment history. Not just whether the borrower is paying today, but how long they've been paid before stopping. How many times they've been late historically. And what happened the last time they went delinquent. A borrower who paid on time for 7 years and went late once because insurance spiked is a fundamental different risk than one who has cycled in and out of default repeatedly. Third is to understand what's driving the distress. Is this an escrow cost problem, which is curable, or is this a borrower who never had the income to support the payment? The data suggests 2026 distress is primarily the former. But verify it, deal by deal. And fourth, know your state. Foreclosure timelines vary dramatically. Taxes can process in as few as 60 days. New York can take 3 years. Knowing that before you buy a note in either of those states matters enormously for how you price risk and structure your workout approach. None of this is complicated. All of it requires attention. Done correctly is the difference between an investor who flinches at every headline and one who reads them and the shopping update. So if this way of thinking about real estate makes sense for you, if you'd rather be on the lending side than the landlord side, here's exactly how Ritsel Notes can help you. The Quiet Wealth Income Builder is our guided education experience journey and first deal experience. If you've been curious about note investing, but you just haven't made that first move yet, the Quiet Wealth Income Builder walks you through the structure, the process, and the actual mechanics of evaluating and acquiring a note, with us alongside you every step. You can find it at qwib.ritselnotes.com. That link is also in the description. Invest with Ritsel Notes is fully passive. We find the deals, we manage the notes, and we handle all of the servicing. You receive secured monthly income without needing to understand every step of the process yourself. This works for US investors and also for international investors. And of course then, the other option is to buy your first note that puts you in full ownership, full yield, full control. We guide you through the acquisition, help you identify the right deal for your capital and risk tolerance, and walk alongside you as the lender for the first deal. All three pathways are at ritselnotes.com. The link is also in the description below. If you're watching this as a subscriber to the Ritsel Notes newsletter, thank you for being here. The blog this week goes deeper on the Adam data and the full case for note investing in a normalizing foreclosure environment. You already have the complete analysis in your inbox. If you found this through YouTube search or one of our social media platforms, and this is your first time hearing about note investing, welcome. The idea is actually straightforward. Instead of owning the property, you own the debt secured by that property. You step into the bank's position. You collect the payments, and when the market sends scary headlines, you read them the way a note investor does, which is very different from everyone else. The next step, if you want to go deeper, is in the description. And if you're the kind of person who prefers to learn by doing rather than just watching, the Quiet Income Builder was built exactly for that. I'll see you next week.